Well, good afternoon, everyone. As Josh said, my name is Jeff Hadachek, and I am an assistant professor in the Department of Agricultural and Applied Economics here at UW-Madison. But you don't need a PhD to know that things are pretty tight out there in the agricultural sector in Wisconsin. And so there's a lot of underlying things that both contribute to that, but also the low margins in the season that we're in right now has a lot of implications for even the conversations that we already had this morning. Investing in irrigation or investing in tile drainage is a lot more feasible and maybe considerate in a when things are good, but whenever things are tight, right, there's not a lot of extra cash flow to go around to invest in some of these projects. But as sort of a catch-22, it's also, years like these where some of those projects and that infrastructure may be most helpful to maybe weather that storm or increase the resilience of our systems. And so today I'm going to talk about I have three different phases of this talk. One, I'm just going to take a look back on the year that we've had and the conditions that we're in right now and what's led us to this sort of experience of having these low margins. Second, I'm going to dive into a little bit of my work in particular, focusing on conservation adoption on farm and particularly an economic tool to help us think about building these resilient soils that Malika sort of referenced this morning, is that how can we build inherent resilience into our systems? And so even when market fluctuations happen, our systems are resilient to market fluctuations, and weather fluctuations happen, that our systems are resilient to some of those shocks. And then lastly, we had an election recently, if you weren't aware, if you weren't paying attention, and what's happening and what's unfolding in the ag policy world looking forward into 2025 do have some pretty major implications for the market conditions that we're operating in, particularly relating to the tariffs and the Farm Bill. And so today I'm going to kind of walk through each three of these. We're going to take a big picture look. We're going to dive into this example of a tool that I have to help us build those resilient soils. And then lastly, we'll zoom back out and think about where we're heading in 2025. So we've seen some of these maps already this morning, and our lived experience sort of informs us. We know that we had this abnormally wet spring. The exact numbers on this were that we had the fourth wettest March through May on record. When we were sitting here 9-10 months ago, it was projected that the drought conditions were going to continue throughout the state. But these sort of abnormally and unpredicted and projected wet spring ended those drought conditions, which provided a lot of soil moisture that carried through the season. But it also, when those rains were happening, it provided sort of challenges to get into the field for a lot of farmers. I think the final numbers on this for prevent plant in the state were that we had something like 160,000 prevent plant acres in corn this year. Only 2019 had higher prevent plant numbers in recent memory, and so those early season challenges were apparent from those numbers alone. And then sort of on the other end of this, to bookend the growing season, we had one of the driest Septembers on record. It was the sixth driest September on record. Every place else other than Dane County had below average precipitation relative to the departures and the normals for the last 30 years. And it was the third hottest September on record. And so as Harkira sort of mentioned this morning and a few others, is that if you take the average growing season conditions, it looks like a pretty normal year, but because of those bookended wet and dry, there were certainly challenges, and that variability led to some challenges. But despite all of that, we ended up with record-breaking corn yields in Wisconsin. The final number on this was 181 bushels per acre, which sort of passed the record that we had in 2021 of 180. And so despite this weather variability and these extremes that we know we experienced, we continue to push that bar. We can push that frontier of what our agronomics can provide us. And for soybeans, it ended up at 49 bushels per acre, so a little bit lower than the last couple of years, but still relatively high, and continued to push that trend upward. But that's about where the optimism ends. We have great agronomics. We continue to be more efficient agronomically, but we're doing so at pretty low prices, right? And we all sort of know this based on what we're marketing right now. So the current projections for the 24-25 growing season, the marketing year that we're in, is that farm prices will be about 410 per bushel. Um, my colleague Paul Mitchell, who's also in the Department of Ag Econ here, recently had some numbers about what break-even corn price would need to be, and it was something like 485. And so in many parts of the state, because of basis, we're maybe going to be operating lower and receiving lower prices than that 410. And so it may be the case that we're operating even close to $1 below break-even price for corn. I wish I had better news looking forward as well. I wish I could tell you that this was, sort of projected to the lowest that this point is going to be, and it's going to be more optimistic looking forward. But looking into 2025 and 26 marketing year, the current projections are at 390 per bushel. So largely this is happening because of large stocks that we're carrying over from the past few years of record-breaking national corn harvests. So you can look at sort of just the ending stocks right here. They're creeping up as we head into that 25-26 season. And so that means that our prices are going to be depressed, at least if conditions sort of hold as expected. Similarly, if you can adjust for inflation, because inflation has been increasing recently and corn prices have been going down. And so when we look at the past 40 years even, these are some of the lowest valued corn crops that we're growing other than a few years in the early 2000s that we've had. And so just more points to illustrate that these are pretty low conditions. I think some numbers came out earlier this week from USDA that said that net farm income is going to be down 6% this year from last year. And really, I think if we looked at specifically just the crop sector of net farm income, it would probably be even lower than that, because livestock has been pretty favorable. And so crops would likely be lower than that 6% decline from last year at this time. So we typically we do have some external programs that are available to farmers, and typically these programs are in place to support in times like this, where we have low farm income, but help sort of provide income relief to be able to weather those storms. And those programs in particular are ARC and PLC from the federal level. PLC, just as a reminder, it triggers if payments in the marketing year fall below a certain reference price. I just showed you those prices for corn. For soybeans, the projected price is going to be 1080 for the 24-25 marketing year. And so if we look at those reference prices for corn and soybeans, even though we're experiencing these really low prices and prices have declined, we're not quite to the point yet where PLC would be triggered. So if you signed up for PLC, it's pretty unlikely, as it currently stands right now, that PLC will be triggered for payments after this marketing year is over. ARC, on the other hand, is revenue coverage. It provides both buffers from price falls and yield deviations below normal. And those are triggered if the revenue falls below 87% of the historical county average. And so we can run the numbers based on what we have currently. And at a price of 410 for corn, ARC would be triggered in this case and in this marketing year if yields are less than 101% of the county average. So there actually is room for growth in county yields, but because of that record-breaking yield that we had of 181, there's going to be a lot of parts of the state that ARC's still not going to be paying out this year because we pushed those yields higher. So corn for ARC is going to be the most likely to pay out this year, but even then, most parts of the state probably are not going to be receiving payouts from ARC. Soybeans, on the other hand, because prices for soybeans are a little bit relatively more favorable, we would need actually 12% declines in yield for this year in order to be able to trigger payments for ARC at this point. And so at this point, the highest likelihood of support and relief that we probably have is from ARC in corn. But even then, again, many parts of the state aren't going to be receiving that. Because of how the price historical averages work between crop insurance and ARC and PLC, you would need even worse conditions for crop insurance payouts. And so most areas probably aren't going to be receiving crop insurance payouts this year either. So all that being said, this is a sort of a pessimistic view on conditions so far. We have low market conditions, and even the programs that are in place aren't likely going to be a support in these times. And so how do we think about this moving forward? And one of the things that I'm going to talk about is just building more resilience and building more agronomic resilience into our systems. And so when those market fluctuations and weather fluctuations do happen, that our systems are more inherently resilient to that. And so as an economist, the thing that we often think about is profit in the short and long run. Do the revenues outweigh the costs? How do prices and fluctuations, what do they mean for sort of the bottom line? But at the end of the day, we also know that there's a lot of other things that feed into the farmer's decision-making function, the farmer's decision-making process, including risk, including knowledge, and including traditions and beliefs. What have we done for years and years? And so when we provide tools and provide economic decision analysis, often we only focus on sort of number one. We focus on are things profitable in the short run? However, we don't typically have good tools or good information to be able to give about managing these other factors. How do we manage risk? How do we manage agronomic risk economically? And how does that factor into our decisions? And so what I want to talk about today is something I've been working on. It is a decision tool. Scott this morning talked about a decision tool for cutting alfalfa. Here's another web-based decision tool that can help better understand and grasp what the riskiness of our agricultural operations are. So like I mentioned, we typically have sort of this partial budget analysis when we think about adopting a practice. And here I'll just give this example for cover crops, is that economists will come to you. We know what the costs of practices generally are. We know we can kind of project and estimate what the benefits might be. And in the end, we get somewhat of a break-even analysis type framework where we give you an exact number and say that, if in this case, for cover crops to pay off, what we would need is a 3.7% increase in yield to overcome some of those additional costs for implementing cover crops. If you're utilizing cost share, some of those numbers can be pushed to be a little bit lower. But this is sort of the traditional approach that economists might come with to give you sort of an analysis on what adopting a practice might be like. But the downsides of this is that it ignores, one, the long run benefits. And as we've discussed from our soil scientists this morning, that those soil health benefits may not accrue in that first year that you implement a practice. And so this single year budget doesn't give you that long-term projection. Second, it ignores risk and what do these practices do to the riskiness of our operations. And particularly thinking about soil health, we know that investing in our soil health may limit our downside risk. This has been shown by our physical scientists, and as well as some of my colleagues in ag economics have estimated that this lowers our downside risk. And then lastly, whenever we give you some of these numbers, it sort of presumes that we have the right knowledge, the right numbers that we're inputting into this system. And getting those numbers exactly right, it's going to vary from farm to farm. And so when we give these budgets, they're never the quote unquote right number that we're giving you. And then just to illustrate this further, just taking some data from FinBin, from the Farm Financial Business Management data, we can see that even implementing cover crops, just the costs that producers are paying for seed can be anywhere from $5 to $199 per acre. I'm not sure what this $199 per acre producer is doing. They're really experimenting with that biomass that they're increasing, but they vary a lot across space and a lot across farm, and so just even the costs that we're incurring can vary. And then the impacts of these processors or these practices that we're implementing can also vary across farm. And so this is taken from some research from some colleagues that estimate what cash crop yield is after implementing rye. And so across Iowa and across Northern Illinois and Indiana, some of those yield hits are pretty large, even up sometimes up to 10% of what the prior to cover crop yield might be. But then other places it's less, it's more modest. There's maybe just a few percent yield hit, like across Southern Illinois and in Southern Indiana. And so ideally, we want a tool that can adjust for all of these different conditions and can adjust for these different estimates and assumptions that we have about what these are doing for agronomically and then the implications for that economically. And so the tool that I've created and you can access on the web right now is a soil health decision tool, primarily geared for our corn and soy cash crop operations in the state. It allows you to adjust output prices based on what the current scenario is. And so, if market conditions change, maybe it's more favorable or maybe it's less favorable to invest in the practice, but you can go test that out. And it allows for users to also adjust for their baseline conditions. So, the farmers themselves are the ones that are going to know what they're typically applying in terms of fertilizer. They have better information about that than I would as sort of the generalist here, thinking about what we look at from aggregate data statewide. But this tool would allow you to toggle these inputs anywhere, what your typical baseline fertilizer requirements are. Are you getting a manure credit from them? What are you typically spending on herbicide? What are you typically spending on tillage? And what are your typical yields? And then the last piece of this is that you can also adjust some of these assumptions about what a cover crop and no-till system might look like for you financially or economically. So you can adjust how much you're paying for seed, whether or not you think you're getting a cover crop credit, nitrogen credit from those cover crops, maybe based on whether you're implementing a legume or just cereal rye. Similarly, how much are you cutting down on your herbicide costs? If you're reaching for a certain biomass benchmark, you can maybe cut somewhere up to 50% of your typical herbicide costs based on how much biomass you have. So you can adjust that assumption. And then similarly, how much do you think of a yield hit are you going to take, or how much yield hit can you afford to take? And so you can adjust and play around with those assumptions here as well. All of this in the baseline is calibrated based on sort of our on-farm Wisconsin trial data that we have, or a combination of on-farm and research station data. So a lot of these assumptions that you're seeing are based on real data that we have based on cover crops. We would love to get more data on this, and I'm hoping to work with some of our physical scientists to better back this up and better make this tool sort of data-driven going into the future. And so what this will look like is gives you a more simulation. It's a simulation-based approach where we're running multiple conditions across the variability that we experience, weather variability and yield variability that we experience in the state, and gives us a more holistic picture of the possible outcomes that we might face, rather than just a single number like our partial budget gives us. So what you're looking at here is you have two curves. One curve, this yellow curve, which is behind, is the conventional system, the payoffs and the distribution of payoffs that we might typically expect in a conventional corn system in this case operation, without cover crops, with conventional tillage. The green curve, on the other hand, is the payoffs and the distribution of payoffs that we expect from our soil health system. And what you'll notice about this, and just how I've coded this scenario up, is that actually, if you look at where most of the mean of this distribution, or the average of this distribution for the soil health system, is actually lower, and the payoffs are actually lower in the soil health system than they are in the conventional system. A couple of reasons for this is, one, we're just looking at this one single snapshot year, right? And so we are investing these additional costs into cover crop seed, cover crop termination. And we're not assuming in this baseline that we get any forage value from those cover crops. And so I did this in particular to illustrate this point that it may be the case that our soil health system actually has less net returns than our conventional system. That could be true. But what this tool then gives you the ability to view is what percent of the time are these systems breaking even? And here again, how I've coded this up in the default is to show that 93% of the time, the soil health system is paying off or is breaking even, but only 89% of the time, our conventional system is. So we may have the case where we're investing these costs and it may not pay off every single year or every single time that we invest, but this gives you a way to sort of visualize how much less risky the soil health system makes and how much resilience we're building into our system because of those that soil health to better manage and better have better soil infiltration for those really wet years, but also have better water holding capacity for those dry years. And so this is just a tool to be able to visualize that and to assess that riskiness. Moving forward, there are still changes and this is just sort of the very initial version of this, and so this is a work in progress. But I would love to hear feedback. I'd love for you to test this out, see what other scenarios you would like to see in this on this tool. And so the link is here, and I can pop it in the chat after we're done. But I would really encourage you and would really appreciate if you go and mess around with it yourself and offer feedback on what you would like to see differently. In the future, I do hope to have this more of a long run capability where we can build in some of these assumptions about how long it takes for cover crops to pay off, given that we're investing these costs now, but not expected to see those benefits for multiple years in the future. So again, progress and feedback is certainly appreciated on using that tool. So lastly, in the last few minutes here, I'm going to shift gears for a little bit and talk about policy uncertainty heading into 2025, because these things and these movements do have pretty significant economic consequences for the markets and commodity markets in the U.S. And so one thing that economists were looking at just sort of in the wake of the election was what are futures prices doing? And so on the x-axis here, you have days in November, the days in November, and these each of these bars are 3-hour trading windows. But you can look back at November 5th, which was election night. And so this first red bar here was when those first results started pouring in on election night in November 5th. So there was a slight dip in corn futures prices as we moved into November 6th, but then as it became apparent that Donald Trump would be elected our next president, the markets ended up actually moving to somewhat more favorable. And so speculators and corn traders were actually somewhat optimistic about this news moving into 2025. In the last few weeks, we've seen those numbers come down a little bit. We're now at something trading at like 430. I think a lot of this is probably driven based on news that we've been hearing about potential tariffs, and I'll touch on that just a little bit. But all in all, we haven't seen huge departures from sort of pre-election levels in terms of what the market is telling us and what the market is expecting. Similarly, for soybeans, we had this dip on election night, and then in the last few weeks, we've seen a little bit lower prices trading at 10.08 right now. But all in all, not huge departures from pre-election levels. Now, the thing though to watch, and if you've been paying attention to some of the ag policy news, even just the last few days, we see some new developments based on this almost every single day. So on November 25th, Trump promised that on day one, he would enact tariffs on Mexico, Canada, and China. And this is significant because Mexico, Canada, and China are our number one trading partners for agricultural commodities. And so raising tariffs on them both limits our ability to bring exports in from those countries, but then the concern for our own and domestic production is whether these countries would impose retaliatory tariffs as a result of these tariffs, and if there's escalation against it that results in sort of a trade war. And so there was this sort of knowledge that after Trump made this announcement on November 25th, that Mexico's president actually sort of responded and said that they would impose their own tariffs to retaliate against Trump's tariffs. And so if this comes to fruition, it actually, we would expect to see pretty significant movements in our commodity markets because of this. Now, I think some of the reason we haven't seen this yet in the futures markets for corn and soybeans is I think there's some doubt as to whether or not these would actually come to be or come to bear. And whether or not this language about imposing day one tariffs is actually just a negotiation tactic to negotiate a better trade agreements, and that may well be the case, but we don't really have a lot of certainty around how that would play out sitting here today. And so we can, though, say that we can look back into Trump's first administration, and there was examples of this in 2018 that there was tariffs imposed on Chinese products and resulted in a 25% retaliatory tariffs for Chinese products. At the time, then there was some sort of this retrospective analysis where some economists have done and estimated that soybean prices dropped about 74%, 74 cents per bushel as a result of those tariffs. And then as a result, the Trump administration facilitated or distributed the market facilitation program and distributed almost $24 billion to U.S. farmers for those damages that they incurred because of those trade losses. So if these tariffs were to come to be, and if retaliatory tariffs were to be imposed as well, we do have some historical context and recent history context as to how large we might expect some of those departures to be. That being said, I think if they were to come to pass, I think that the administration and the Republican House and Senate would be pretty incentivized to make sure that farmers are made whole of the damages that they impose. And so because we have historical precedent for this market facilitation program, if these tariffs were to come to pass, I wouldn't be surprised if a similar type package would be instituted to pay farmers for those damages. Then lastly, the Farm Bill is something to watch over the next few weeks as well. The funding for the current extension of the Farm Bill, of the 2018 Farm Bill, expires on December 1st. It's not likely that we'll see a whole Farm Bill package, a 4-year Farm Bill package passed with the lame duck Congress. And so I think what we're likely to see is a 1-year extension to the current Farm Bill again, and just continue to kick that can down the road. In 2025, the Farm Bill that would be passed could be Republican majority in both the House and Senate. And so I think some of the things that they'll be focused on is providing more ex-ante disaster relief, things setting aside funding for things like the market facilitation program, and increasing those reference prices for ARC and PLC so that maybe in years like this, it's more likely that we would see those payoffs, right? So I do want to just give an advertisement for the Wisconsin Ag Outlook Forum that's happening on January 21st. The theme this year is going to be Wisconsin agriculture under a Trump presidency. I will point out that this is happening on January 21st, which is the day after Election Day, or Inauguration Day, excuse me. And so whether Trump imposes those day one tariffs that he's talked about in recent days, we'll actually know whether or not that's true come January 21st. And so we'll have a better idea of what that might look like. But we're going to talk about labor, we're going to talk about tariffs during the Ag Outlook Forum. So I would encourage you to attend either virtually or in person if you're interested. So that being said, our farmers are dealing with both weather extremes, market extremes, and policy extremes that we have to navigate and make decisions around moving into 2025. I hope that this tool that I've developed will help better weigh those costs and benefits and analyze the trade-offs of investing in soil health practices, but we can also see some of those benefits in terms of the increased resilience. And then many things are uncertain as we move into the future administration and move into 2025. And so just continue to watch how some of these things evolve because they do carry pretty major consequences for Wisconsin agriculture and the U.S. agricultural economy more broadly. So that's what I have. I think there's probably a couple more minutes. I would be happy to address questions in the chat if folks have any. Otherwise, you can reach me at this email here if there's any other questions that come up later.
Thanks a lot, Jeff, for sharing the update with us today. And we do have a couple things we would like to talk about for a minute or two. questions that have come in during the week. One of the things that we're wondering about, Jeff, is the soil health tool that you created. Has there been discussion with the crop insurance industry as far as maybe thinking about the risk management that soil health practices might have on that yield
Yeah.
component of crop insurance?
Yeah, so I have not had those conversations yet, but this is something I would love to think about moving forward because, yeah, you're right. As we invest in some of these practices, we should be rewarded because our premiums should reflect that we're, building a more resilient system. And so we may not experience those same swings that we're typically used to in sort of our year-to-year conditions. So I have not had conversations with them. I've been working in somewhat conjunction with some NRCS folks about using this tool for technical and financial assistance. But that would be something that we have things in Wisconsin like the crop insurance rebate. You can get $5 per acre for investing in cover crops, and that's sort of based on this idea that you should be rewarded for decreasing the riskiness of agricultural output generally. But
Okay. Sounds really good. One last piece that we would like to share. I'm going to have Liz drop in the crop enterprise budget tool that UW-Madison has. We just updated that in April of last year, Jeff, if that's something that you've seen or worked with some with, in conjunction with your work with Paul, but
yeah.
really knowing our costs and knowing our markets, anything to kind of say about those two, thoughts going into next year?
Yeah, so one, I mean, we have with the decline in output prices, we have also seen a somewhat decline in operating costs. And I think the projection, this is again from Paul Mitchell, my colleague, was something that operating costs are down something like 7%. And so because those costs are sort of determined based on supply and demand, I think these two things sometimes move in conjunction with each other. And so, yeah, the costs are declining as well. But I think depending on what happens with tariffs and which countries are would have tariffs imposed on them. One example of this is potash, um, like 80 or 90% of US potash comes from Canada. And so if those tariffs were imposed on Canadian potash in particular, I think we would expect those prices to go up because we don't really have another alternative market for those other than the Canadian market. So those would be examples where it'd be sort of differentially affected based on what plays out. But yeah, thanks, Josh.
You bet. Thanks a lot, Jeff.